I almost get asked this question every time, and I really pity the broker because they always get the first blame. Alright, so today in the video, I will tackle why do you get stop out even though the price never hit your stop? Or why do you get stop out even though the price never reached the price level in your chart, especially in Metatrader chart or in TradingView? And second question would be, will switching brokers fix the problem that you are facing? Right, so first, to understand the problem, we have to understand a few concepts in trading. And this applies to any instrument. So whether you are trading into Forex indexes or whether you are trading this in futures or in CFDs, whatever that I'm going to discuss today will be applicable. So first, let's understand that stop loss is a limit order. So all limit order is not guaranteed, because when the limit order is hit, then that limit order will switch to a market order. Then what is a market order? Your market order means that you have activated your limit order. That means that when your stop loss level is reached, that limit order is activated, and that the broker would then send your order to the pool, to the liquidity pool, right, as a market order. So when there are demand or supply, alright, then the liquidity pool will fill your order, and your broker will try the best to guarantee that it's being filled at the price that you asked for, which is the limit order. But a market order, the execution price is not guaranteed. Alright, because your market order will depend on the supply at that point of time. Okay, so for example, let's say your stop loss, when you put it in, then it will be filled at the next available bid. Now, the next available bid means that whether there are people who are willing to buy from you or who are willing to sell to you. And the next available bid will depend on many other factors. For example, let's say there's extreme volatility or there's extreme fear. So people won't want to take your orders from you, isn't it? Okay, or where the trading hours is just like there's not a lot of liquidity. Most traders are sleeping. Most markets are not open. Okay, especially between the last few minutes of the closing of the day, where it's about to close, or the first few minutes, or even the first few, let's say half an hour, all right, of the day where it's starting to operate. So these are the trading hours that's not very liquid, because traders are basically sleeping, so there are not a lot of people who are willing to fill the orders. Now, of course, that if you're trading into, let's say, not the majors, like you are trading into the minor or even exotic, then traders are not really trading into this, and there's not a lot of demand and supply, and they're not willing to fill the orders at the price that you wanted. Okay, so if, let's say, there's no enthusiasm, then the spread will increase. Alright, when the spread increases, then your stop loss, which is right now a market order, will not be filled at the price you asked for, will be filled at the price that the next person or the next trade is willing to fill you. Alright, so let's understand, for example, what you see on the chart. Now, right now is Sunday. The only market that's open to illustrate this is from the BTC. So I've extracted the chart here in BTC, and you see that there are two lines here. One is the black color line. The black color line is the bid price. So when you are using Metatrader or in TradingView, the default price that you see is the bid price. Okay. However, if you activated, let's say, Metatrader 4, and you can see the ask price. So I have configured here the blue line, which is the ask price. Later on, at the end of the video, I will show you how to get your ask price. Now, the gap, right, the space between the bid and ask price would be the spread. Now, note that the spread will increase or decrease. That means the space will widen or narrows depending on the situation of the trading condition at that point of time. This is the bid-ask price of BTC at this moment. Say, for example, you have a short position and you short BTC at 969.50. Okay, the bid price at this moment is quoting at 969.46 and 969.64. Now, let's say you have a standard account and it's all in, all right? even when you have shorted the BTC at 96.95, 950, by right, you should be making $4. Okay, because as you can see on your price chart, that right now is 96946 on the price chart, because as I explained, price chart always show the bid price. However, if you look into your account, you won't be seeing a profit. Okay, because the system will assume that, hey, look, if you are being stopped out, let's say, for example, if you need to, because you're short, right, you need to buy back your position, then you always have to buy back at the higher price, the ask price. So as I said, right, you buy at the ask price, okay, you sell at a bid price. So in this case, even at shorting BTC at 950, the current price is 964, your trade would be a loss. Now let's say, for example, you put in a stop loss at 960 and you say, hey, look, 960 is not being shown on my price chart because, you only show 946, which is the bid price. But 960 has been reached because your ask price is already 964. So 964 will trigger your stop loss of 960. Then your stop loss, which is the limit order, would now be sent to the liquidity providers, which becomes a market order. But if let's say there are no traders who are willing to take your orders, all right, at 960, because then today is a Sunday and only 2% are trading, you and the other person. So the other person not willing to take your order at 960 and say, okay, if you want me to take the order, then I will only be willing to fill the trade at 980, because this is the only price that I want to take the trade. I only want to fill at 980. Now, because your order right now is a market order, because your stop loss is being triggered and is right now a market order, then your trade will be filled at 980. Okay, so what is your actual loss? Your actual loss would be where you shorted at 950. You thought that you could be stopped out at 960, which is $10, but no, because the next available bidder for your trade, it's only at 980. Hence, your actual stop loss would be 30 right now. Okay, so we call this a slippage, meaning that we say that this is a slippage of your stop loss. Okay, what is your slippage? Because you wanted 960, right? You're filled at 980. So your slippage right now is at 20. Is this true for all brokers? The answer is yes, because this is how the market is working. Whether you are going to A broker, or going to B broker, or C broker, or the best broker in the world, as long as the brokers is not offering a fixed spread and the broker is sending the liquidity to all the liquidity providers, and your banks, your tier 1 banks, your tier 2 banks, they won't be that stupid to fill you at the price that they don't want. I mean, they would fill you at the price which is reasonable and acceptable to them. So hence, if you are trading into the wee hours, or if you are trading into a pair that's like not widely traded, which is called exotic pairs or even a minor pairs, or when there's a lot of fear, then the slippage would be higher. I would really think that it depends, because this is an inherent problem of the financial instrument. Whether you are trading futures or whether you are trading stocks, you still have the spread. All order types would be in the market as a market order and depends on liquidity provider to fill you. So I would think that when you switch brokers, it doesn't help, because then this is just how the financial markets is functioning. So this is inherent to all the instruments that we are trading. So there are a few things to tackle this. Number one, you want to go to the brokers with lots of liquidity provider, especially the tier 1 provider. Let's say, for example, your broker, this is your B, has only one LP. So you are only getting the quote from one liquidity provider. But what if your broker has 3 LPs, okay, LP1, LP2, and LP3, right? And then these liquidity providers are able to provide competitive quotes, right, to the brokers. And the brokers will choose the best from whichever is being quoted to them to fuel your trade. So you want the brokers to have lots of liquidity providers. And then of course that slippages is something that whether you go to A, B, C broker, I would say you go to 100% of the brokers out there, slippages will always occur. And whether the brokers are willing to accept that the slippage is not reasonable. Say for example, right, you put in the BTC order and your slippage is $1,000 from the price that you put in the stop loss. And of course that you know that $1,000 is not reasonable. So for example, when you are trading Forex, okay, let's say you are trading a Euro pair, Euro USD, where usually the spread is 1 pip. But your slippage at that point of time where you have NFP, non-farm payroll, and it's during a, let's say, 1st of Jan, right, where you know that most people are not trading, and your slippage results in your euro being filled at the price that you asked for by another 5 more pips. So instead of filling with a spread of 1, you are away from your limit price, your stop loss by 5 pips. So is this reasonable? I would think that it is reasonable. But what if the euro is being filled at, let's say, 30 pips away from the usual, euro spread? And would this be reasonable? I would think that this is not reasonable because this slippage is simply too far out. So if it is not reasonable, then you got to ask whether you have the bargaining power to ask from your broker for the compensation. So for example, if you're unknown to your broker, you don't have collective power, right? So of course the broker is not going to entertain you and is just going to give you some answer to say that this is part and parcel of the spread. But again, that if you are going with a broker where you do have a very nice relationship, and because the brokers want your business, of course the brokers will say, okay, fine, let me just compensate you on goodwill. Okay, so there are a few things to take note of. You want to trade on liquid pairs. Okay, so you do want to avoid most of the time, all right, illiquid pairs or even pairs which are exotic pairs. All right, so for example, I don't encourage pound sync or I don't even like euro sync because they're simply just not liquid. These are just exotic pairs. Even Aussie cat, even Kiwi cat is something that I only want to trade before the end of the week, because I mean this spread issues will occur very much during the weekend, especially the close of Friday and the start of Monday, right? Because they are not liquid in the first place, and especially these are exotic pairs, right? Or minor pairs. They're even not that liquid, and the spread is taken for granted to open up, and you gotta face the problem. And of course, then you want to have reasonable stop. Unless they're scalping, you want your stops to be reasonable. So I hope that this video offers you the understanding that it is not always the broker's problem that you are being stopped out. First, right click on your chart and then go to properties. Under properties here, you can choose your ask price as a different color. Then go under common and then click this one, show ask price. You will be able to get 2 prices on your chart. And as I explained, the black color default line is your bid price. And if you do not show the ask price, all right, so by default, only the bid price will be shown. Have you clicked the subscribe button? And how about a like?